All right, so the next video in sequence here, T2, Trade 2, Condor, core guideline PDF. All right, now, what I think you're going to notice is this is quite similar to T1 and T3 and T4. They're all subtle variations of one another, but the management and the construction is going to be a little bit different. So let me just take, again, a few minutes at the beginning. We're going to go through the setup, the proposed adjustments, the management considerations, and then we will step through some different market scenarios, and I will also show you a couple of live trade plans and how this trade performs. All right, so you'll use the SPY for learning, all right, but just understand that you can use this in the SPX and the Russell and the NDX, any underlying equity. They are all going to have individual and unique personality traits to them. So I recommend and I suggest highly start in the SPY. It's the most liquid. It helps you get a feel for it. Of course, this is after you have back tested it, after you have sim traded it, after you have really thoroughly tested it. But once you're ready to go live with it, I'd like you to start with a SPY and then migrate up to SPX or Russell as you feel it's necessary. Okay, but let's just go ahead and walk through the actual setup. Capital allocation, we're going to decide, or we're going to designate between 2,500 to 5,000 margin per tranche, and again, each tranche is just considered as one unit, if you will. We're going to open this 20 to 40 days to expiration, longer days to expiration in low volatility, shorter in high vol. Do not open in an expiration week. Prefer to wait for a down day. Again, these are all just considerations and suggestions. They are not hard and fast rules. But if we are VIX at 10 or 11, well, I'm probably going to be going out to 40, 50, 60 days to expiration, versus if a VIX is massively elevated or the highest IV rank it's been within the last year, well, I'm probably going to feel comfortable and more inclined to go 20 or 30 days to expiration. Either way, this is a good starting point. So your strike selection, put credit spread 8 to 10 delta, 6 points wide, 5 contracts total. Step 2, put debit spread 1 point below the money, 5 points wide. This does not use a call credit spread. So let me just stop right there. We'll go to SPY. And this is looking at the market middle of January of 2017. And this is what the price chart looks like. All right, so we'll go out here. You'll see volatility in the over the prior year. It is absolutely in the lower range. So I would be saying, well, we're going to probably go out maybe either 59 or even 73 days to expiration. Let's just go to 59. So first, right off the bat, we are going to look at a put credit spread 8 to 10 delta, 6 points wide, 5 contracts total. So 8 to 10 delta, we'll just come right here at 9.65. We'll say 5 contracts, 1, 2, 3, 4, 5, 6, 6 points wing width. 6 points wide, 5 contracts total. All right, so that is the core component of your put credit spread that starts out looking like this. All right, you have this much risk, $28.75. You have $125 worth of maximum profit. You have 59 days to expiration. Okay, that's step 1. Step 2 is a put debit spread 1 point below the money, 5 points wide. So we will say we'll convert that trade. We will go 1 point below the money, so it's at 227 or 226 and some change. So let's just go, we'll go 225. How's that? We'll go 1 point right below the money, 5 points wide, and we'll say 1, 1, 2, 3, 4, 5. And you'll notice that, again, I'm only using one contract here as opposed to 5 on the credit spread. The reason for that is to get this profile that looks similar to this. Again, the PDF has this kind of a profile after some potential adjustments, but your construct at the beginning is to get your profile with little, if any, risk to the upside. All of you're defending it to one side only, and you've got ample profitability potential for a market that will have plenty of room to roam around over the next 59 days. Okay, it's $2,500 trade. This is one tranche, so depending on the market condition, the days to expiration, the strike selection, that's why I say one tranche will be anywhere from $2,500 to $5,000 worth of margin. So this particular trade will have $2,504 of margin. If we did two contracts, let me just show you what that will do to the actual trade. It puts a lot more risk to the upside. However, what ends up happening is you still have that profit potential to the downside, but you are no longer delta neutral. You are delta negative. You have delta of minus 14, all right, as opposed to only doing one. You have a delta of 0.92. So I want that delta, that T plus 0 line, to be as flat as possible while we're waiting for time to pass. So that's the construct. That's how it starts out. Now, this does not use any call spreads, so we're all in the puts. We're out of the money. Minimum target is 3% of deployed margin. Realistic 5 to 10. Optimum is anything greater than 10. Maximum loss is 10% of deployed margin. So if I put on a $2,500 trade, I am not wanting to jeopardize losing more than $250, which puts me down around this area here. As it begins to really start sloping down, you know, this hill of pain, if you will, we get to this point here, we better be closing the trade. Now, if we don't get there for, let me bring this down a little bit. If we don't get there for, you know, say the next 39 days, well, now we don't hit that minus 250 until a little bit farther underneath. So the idea is we are using this short strike right here, right, the lower short strike, as the absolute line in the sand of where we'll probably cut out if we violate that or make a maneuver, make an adjustment, if not beforehand. Okay, so that's the maximum loss calculation. Minimum target is 3%. So if I'm deploying $2,500, you know, if I want to make $75 or $100 on this trade, well, you can easily see this trade has the maximum it can make is $500. So it's not a big winning per trade profit, but you have a lot of room in which to let this market roam around while the premium, while the theta is decaying. So it's never going to be one of those scenarios to where you're going to make, you know, 30, 40, 50, 100%, but we have other strategies and we have other trades that have that potential, so we don't necessarily need to have that in every single setup, right? So that's the way we'll start the trade out. Now, initial adjustments. If when the market crosses the short strike of the put debit spread, so right off the bat, I want you to notice this is the put debit spread here on this upper range. This is the put debit spread. This is the put credit spread. So you've got the debit spread up here. We've got a long that we purchased. We've got a short. We've got a short here. We've got longs that we purchased. We've got 5 of them down here. We've got 1 of them up here. Okay? So what we need to notice is that if we get under this short strike right here, we are nowhere near maximum loss, but that's first adjustment. That's kind of our first maneuver to say, all right, well, time to do something. And what do? We either close the original put credit spread and reopen it farther away, or purchase a butterfly that cancels out the offending strikes. New shorts overlap the original longs. And all that means is we're moving these shorts farther, or we're moving this whole entire put credit spread farther away. And you'll see, I'm going to show you some live examples of trades that have been taken, how that reacts. As far as any upside initial adjustments, there are none. Secondary adjustments, so let's say that you've made one adjustment. Now, if when the new put credit spread doubles in value, you buy in as many short puts to flatten your delta, and you do not roll this a third time. And what you'll notice is this is a trade that will get no upside adjustments initially or secondarily if the market keeps moving to the upside. So let me explain this right here. When the put credit spread doubles in value, so what did we sell this put credit spread for? We sold it for 77 cents. We sold these. We bought these for 52 cents. So 77 minus 52 is $25 times 5. All right. So we have generated a $125 credit into the account. If that put credit spread becomes valued or will cost us $250 to get out of it, that's what we're monitoring for, that second adjustment. So when that put credit spread doubles in value, and that's, I may reword that because that is a little bit misleading. What I'm wanting you to understand is if whatever credit I took in for that put credit spread, when that becomes twice as much, in other words, if I sell it for $1, when it's going to cost me $2 to buy out of it, all right, then I need to get out of that trade. So, and you'll just buy as many short puts as necessary to flatten the delta. Some adjustment notes: low vol environments make it more challenging. Must be patient on entry. Cannot over adjust and micromanage this trade. It's either going to hit target profit, or you're going to hit maximum loss, or you're going to close it as you get closer to expiration. Consider waiting for down day prior to entering. Not a hard requirement, but a consideration. When you get close to expiration, consider closing the put debit spread to manage your deltas if you're riding it into expiration, especially if the put debit spread goes in the money. All right. Immediate exits: max loss Friday before expiration. Price action penetrates and trades under the long strike of the put credit spread. And you will notice that this is the lower long strike of the put credit spread. If we get down underneath that, we have more than violated our maximum loss. So we really are paying attention to this slopeability, if that's even a word. I don't think it is, but the angle of this slope for how that's going to align with our maximum loss and these lower long strikes. All right, so let's just say that that's our trade, and we'll go through, I don't even know if this is going to get into trouble. I don't think it does, but I'll show you some live trades and talk through the adjustments that occurred. All right, so you'll see right here, as time passes, this T+0 line begins getting morphed into this. So the ideal and optimum scenario is the market. We always want to know where's our risk, but then where's our profitability at. The ideal scenario is we stay anywhere between here and here at expiration. If we, the ideal scenario is we stay out in this area here for a few weeks, and then the market drops down into this area here. That's going to give you those months that are going to give you more than a 10% return on margin. Not return on the account, return on margin. This is a $2,500 trade, and we are 25 days or even 38 days into it, and we get a move down, you can easily see we're nowhere near under this tent structure, and we've already hit more than 10% return on margin. So that's the ideal optimum scenario. Now, let me go through, we'll just go a couple more weeks in time. Again, you have to be patient with this type of condor and just let the market decay. Now we're coming to 29 days to expiration. We're still way out up in this area here. We will not hit maximum loss if the market goes up to infinity and forever. And if it continues going higher, well, you either close it, redeploy capital in another cycle or another trade. I am not a big fan of doing these upper rolls like we had shared in the T1 setup, where you do something like that, just because it adds more downside risk. And you're really, the benefit that you're gaining is so limited, especially in the SPY. So it's one of those trades that's really kind of designed for traders who maybe have a full-time job, maybe have a part-time job. You're not able to sit in front of the computer all the time, and you want to just be able to trade something that you can look at every few days, see if you're getting into trouble, if you need to close it, if you need to protect your profits, or if you just need to wait for target profit to hit. And it's one of those, it's a very forgiving style of trading. And if you see that you have several cycles overlapping, for example, let's say you open this trade 13 times a year, so every 4 weeks you're opening this setup without regard to market condition, market direction, whatever the market's doing, it does not matter. You open this up every 4 weeks. At the end of a year, I think you're going to be very, very happy with the results, because the majority of the time you might have a break even or a scratch or a small winning trade, maybe 1% or 0.5% or something, and then maybe once or twice it will fall back and participate perfectly, and you hit an 8 or 10 or 15% month. And you do that over and over and over again with keeping your risk as small as possible. Your account grows. All right, so let me just do this. Let me actually close out of this. I want to bring over I'm gonna bring over a couple of trade examples. I'll show you my trade plan here. All right, and I will do my best to keep this video much shorter than the last one. I really don't want to keep these going up to an hour or longer. So let's just look at this. Now, this is a trade that was put on March, 30 days to expiration. It was put on the 18th of February. Maximum capital, this is my trading plan, where I take my screenshots and I add that to the video recaps of trades that I take. I want to know what my target profit is, what my maximum loss is. If I'm putting on a $10,000 trade, that's the maximum I'm willing to spend on this trade, on this cycle right here. All right, right here, it's one trade. It's going to set me back $10,000 of margin. Currently, at the outset, it was $81.90. I'd like to make $1,000. I'm willing to lose $1,000 to do so. So right off the bat, please recognize it's a 1-to-1 risk to reward. This is what the market looks like from a monthly time frame, from a weekly time frame, and these are the trade executions. So you'll notice that the put credit spread was opened first. I opened up 4 and open up a 5th one, and sometimes it will happen that you put in an order for 5 and it fills them separate. I don't know why that is. I don't know if it's smart routing or whatever the case may be, but you'll notice I generated a $115 credit per contract, per spread. So right off the bat, if you say 115 times 5, I've generated a $575 credit, and I have paid a $719 debit to protect that upside. And you'll see this is what the trade looks like at the beginning, at the outset. So you'll see that it has that nice risk profile, very little risk to the upside. In fact, 575 minus 719 gives you $144 on a 8190 trade. It's 1.7% maximum risk. Nowhere near $1,000 of what I'm saying I'm prepared to lose while I'm letting this trade develop. So this is the price action at inception. Again, I cannot recommend enough to take screenshots, make notes, jot, add to your trade journal. What works for you is going to be different than what works for me. This is what works for me. It's a very good graphic, visual illustration for me to say, all right, this is this rectangular box is the final 10 days of trading. This is where I receive my maximum payout, if you will, and you'll see that it's from 1220 down to 1120. So it's from 1200, well, this is the short strike, down to 1120. This is where I receive maximum payout. 1250 and 1190 are where I will do my adjustments. So you've got 1190 and 1250. So I plant those price slices on the risk profile graph so I can quickly see, all right, if Russell's at 1222, I'm not doing anything until we get to 1190 or 1250. And that's just becomes a hands-off way of saying those are the two values that I'm monitoring now. And then this is what it looks like at the end of the first day. You'll see, you're up about $40. This is what the market did. No images on the 19th. On the 20th, now we're up $142. Again, nowhere near our target profit, but we've been in the trade for 2 days. And this is what, the price action looks like. So we'll just keep scrolling forward so you can kind of see how each day, what's happening. And what's important to notice is that as each day passes, this T+0 line gets pulled up higher to the upside. And that's what lets these short options, these are going to decay at a different rate and a different speed than these are. And so, we want to be aware of how that's impacting the overall strategy. All right, so just keep going forward. Nothing to do, nothing to do, nothing to do. Now we're getting up here to that 1250 level. We can decide if we're going to make an adjustment, take profit. Again, the simple guidelines say no upside adjustment at all. You can edit that to fit your liking if you would like to, but again, this is the starting point of how you'll begin trading this setup. I made an adjustment to where, what did I do? Is I closed the 1220 and I opened the 1205. So I took this profile here, I closed that and I opened it at 1205. And so what that did is that locked in a guaranteed profit to the upside. Again, risk mitigation at all levels, every step of the way. And now you can see this gray box here tells me where I will be profitable from all the way down to 1120 to infinity on the upside. That covers almost 6 months, well, from back here to end of October to March of trading activity. And you'll see that is it less than the $1,000 target profit? Yes, of course. But where is my $1,000 maximum loss? It's way back down here, 100 and some points away. So I will gladly take that trade-off, reducing my target profit while putting more distance between me and the maximum loss. And so that's just kind of how the trade continues to develop, and you'll see you're starting to get some bearish candles. And then, you know, in hindsight, you can always say, well, that adjustment maybe would not have made sense because you didn't hit 1250. If you wouldn't have made that adjustment, you would be up a lot more. Yeah, of course. But if it would have kept going up, I would have been losing my $144 instead of turning this into a guaranteed winning trade. So again, it's trade-offs, but this is the initial way to set this up. Now, notice that the theta has now become negative. At that point, I began getting a little ready to close the trade up. All right, this is peak profit here. We are now coming up just a handful of days to expiration, and theta has become negative. I'm not going to really capture much more than this unless we get a sizable move down, and maybe I'll make a few hundred more, but not significantly much more. So your choice is either to close it and use this margin elsewhere, which is a very valid method, or ride it into expiration, accepting the fact that, you know, you've got still, you know, $8,000, $9,000 worth of risk on this trade. So all options expired. This was the price action at closer, and this was a trade that was open for 30 calendar days. The maximum margin ever required was 81.44, and net profit was 232. All right, so again, some months, what did I say? Minimum is 3%. Well, we didn't hit minimum, but you know, we were close. Realistic is anywhere from 5 to 10. Optimum is greater than 10. The majority of the time, you're going to fall within that, you know, 3, 4, 5, 6% range, and you'll see that, you know, this was one example that happened. Here's another example, and I'll just do this right here. So it's the same kind of setup. It's going to react exactly the same. I am allocating more, same target profit, same maximum loss. There's monthly, there's the weekly, there's the daily, there is the trade inception. And the reason, see again, you can use your knowledge of how options operate to say, what do we have? We had a gigantic bullish candle right here, and then a lot of buying pressure back up to the all-time highs at that point in time. So my thinking at that time is, let me take a directional trade that is going to be part of the larger structure, and if I'm right, I gain almost immediate profits in the trade right away. If I'm wrong, well, I still have plenty of time to add that lower put credit spread. So what this variation of the setup and of the PDF is to say, well, maybe I will put on that put debit spread first if I think that we're going to get some kind of a bearish move. If it does happen, you build, you know, great profits right away. If it doesn't, we still have plenty of time to get the second portion of the larger trade on. And you'll see that the trade's starting to take a little drawdown. You know, it's starting to move around. More drawdown. You know, it's nowhere near, remember, $1,000 is our maximum allowable loss. Does being down $55 bother me at all? No. So, again, at this point, we're saying we'll close that up. We'll realize a $173 loss in 8 calendar days. It didn't work, and, you know, I'm not going to be upset one bit about it. But now what I'll do is I'll say, well, let me go ahead and add to this cycle, and I'll just create the basic setup that we're talking about here. 5 put credit spreads to the downside, a delta 8 to 10, 1 put debit spread right at the money, and you'll see that I generated a $130 credit times 5, which is a $650 credit, minus a $550 debit. So that gives me it locks me in a guaranteed $100 profit at the outset to the upside. Again, it says this is my profitability box. I've got, handful of weeks to expiration, and then the trade just begins to work. Once the trade is launched, it's hands off at that point. All right, you have to say either it's going to work or it's not. You cannot overanalyze. You drive yourself crazy thinking about all the what ifs. You create your plan. You have confidence in your method and your plan, and then you let the market play out. When that happens, you can say, all right, I'm just following my trade plan. I am not having any opinions. I'm not having any emotional, attachments or any, stress, because I've tested, I've sim traded, I've live traded small amounts. I've developed the confidence in the methods, and then you say, okay, well, this is just what happens. It's going to either work or it's not, right? And so then this is another look in option view. You'll see 17 days to expiration. You've got all of this profit waiting underneath, and you've got a market that's having some pretty decent sized bearish candles. So, there's really nothing to do. You haven't hit your target profit yet. You're getting now, well, what do? We came all the way down here to 1220. 1220 is where we said we were going to make an adjustment. Did it completely violate that level? It did not. All right. So it did not close below, let me scroll back up here, this 1220 level. You can see right here, that is the short strike on the put debit spread right here. All right, that's the short strike. It did not violate it, and that is nowhere near maximum loss of $1,000. So it got really close, right? It tagged it. It violated it intraday, and this is that situation where if you're micromanaging these types of trades, you have to be patient with them. You have to just let them work. But if you're micromanaging it and intraday you make an adjustment because that level got violated, well, guess what? Then look at how upset you're going to be when it reversed, and that was an unnecessary adjustment that did not need to occur. Now, on the 4th, PPM just means I'm in profit protect mode, meaning I now have a very nice winning trade on the line. It's at this point probably up, almost 10% on margin. So I do not want to jeopardize letting that go back to zero. In fact, I'm probably not going to let it go much lower than about 6 or 7% if I'm up, 10% or more. And that's just my way of managing, nicely profitable trades. And so, yeah, you'll see the very next day, just close the trade. We had a move down. It closed below 1220, and I just closed the trade. So again, I have to calculate and take into consideration my bias at the beginning was I was trying to time this entry where I was trying to take advantage of this big bearish candle, the retracement up that couldn't clear the all-time highs. And if that would have happened and we would have gotten a substantial, say, 30 or 40 point move down to 1220, if we would have moved down to 1220, well, you can easily recognize that my $500 trade, my $500 maximum debit, puts me up almost $500 immediately, and then I begin building the second half of it, which are the put credit spread side to it. All right, that did not happen in this trade, so oh well. Move on to the next. I was maybe a few days too early, and that's just trading. It really is just, sometimes it works, sometimes it doesn't. But if you have a plan, then you can have peace when it works. You can have peace when it doesn't work, because it just doesn't bother you. So anyway, so we violated the 1220, trade was closed. So I have to take into account the minus 173 that didn't work at the beginning, add to the 638 that I gained on the second half of it. So the net profit is 465. So a little over 5.5% in 28 calendar days. So again, it's a very simple, straightforward way to take some simple guidelines, and what I'll do is I'll show you one more trade here in the IWM, and you can just follow these very simple guidelines, and I think that this is the one where we roll the butterfly down. So start it out like this, same kind of approach. You have defined values in the beginning. You can say, all right, I'm nowhere near my maximum loss. I'd like to make 50. I'm willing to risk 50 to do so. All right, it's a $500 trade. So you'll see I've got $500 at risk. I could let this thing go all the way down here, and it's not a big deal, but you have to have your parameters where you say, I'm willing to risk 10% of that margin in order to make 10% of it. And we'll just kind of scroll through here. You'll see that we're about halfway to our target profit. Market's just bouncing around. And when I say this is one of the most forgiving styles of trading, I cannot emphasize that enough. If you are approaching it with you're managing your risk first and you're looking for profits second, some months are going to be great, some months are going to be not so great. Very rarely will you take maximum loss trades. And so you have to say, all right, look, I was very content. I made $29 on a $485 trade. So almost 6% in 24 calendar days. It's not the absolute value that's important. It's the return on capital deployed. And when you build that confidence, guys, that's what becomes important. So let me run through real quick. Let me. Hopefully this one kind of gets into trouble. I don't think it does. So let's do this. Because I do want to show you the butterfly adjustment and how you can roll down. If we go back here, we can say, why don't we just come in here? No, I don't want to do 2011 again. Why don't we go here? Let's say that we put it on this day, 5/22/13. Let's see what that gives us. 5/22/13. Okay. So we'll just say we'll come at 59 days to expiration, same kind of setup. I don't want to do the SPY, let's do the SPX. All right, so 58 days to expiration, I'll come down here. We'll do delta of less than 10. And if I'm going to say I will do 5, and I'm at 1510, so we're going to need to go to 1450. We'll do 5 here, and then we'll do 1 here, and we'll do 1 here. All right, so it gives us a little delta positive value. Again, this is the SPX, so it's 10 times larger than the SPY, so it's not a $2,500 trade, it's a $25,000 trade, but it gives you the same risk profile approach, right? You've got all but no risk to the upside. You don't get into any trouble till you get down here, and you saw that we do get into trouble, so this will be a good example to show you how you manage this trade to the downside. Again, if the short strike on the debit spread gets violated, we're rolling down, and we're not there yet, right? Follow the guidelines. Just follow these when you're starting out, and that will keep you on track. All right, so cross the short strike of the put debit spread, close the original put credit spread and reopen farther away, or purchase a butterfly that cancels out the offending strikes. All right, so let's just, I think it's in here. All right, there we go. So we're at 1610. We have closed officially on a Wednesday underneath there. So that means that the next day we're going to have to make an adjustment. So let's just go to the next day. We know we're going to have to make an adjustment. We're down $718. Again, if we're using the SPX, if the SPY I was willing to risk 10% of deployed margin, well, that's only $250. 10% of this would be $2,500. If I'm down $2,500, or if my maximum loss is $2,500, being down $750 shouldn't bother me. But be that as it may, we'll say we were under the short strike at the close of the day yesterday, so we need to make an adjustment to roll them down. So we can do one of two things. What we can either do, okay, so the choices that you have are, A, you can take this upper spread, and that's too much there. We'll go, got 1650 to 1610, and then we're going to roll this down to 1570. Well, hang on just 1 second here. Okay, that's what I was doing. I was purchasing this long down here. So what you're doing is you're using a, you're selling a butterfly. Essentially, you're selling this one, you're buying these two, and you're selling this one, all right? And so as a trade, that's what it looks like. You're selling a butterfly. But when you layer that on top of the original put debit spread, all you're doing is you're rolling this upper long down to here and this short down to here, and it gives you that approach right there. All right, that is one maneuver. The other maneuver is to say, okay, well, what if I take here and if I buy 5, sell 10, and buy 5 more here? It's the same kind of adjustment. It's just rolling the shorts down, okay? It flattens out that T plus 0 line. However, if you take and you increase the size to either 7 or even 8, all right, what that is going to do by increasing that size, that gives you this kind of a profile, or this kind of a look that you see on the PDF. Okay, so what it does is it helps you continue to weather the downward pressure, the downward movement, while giving you peak profit down in this area, while if it reverses and goes back to the upside, well, then it's a matter of just rolling these upper longs down. As always, though, immediate exit if max loss is reached, or price action penetrates and trades under the long strike of the put credit spread. So, you know, you have, I hope what you see here is many different choices on how you can maneuver a trade that, you know, is getting ready to, you know, potentially drop pretty significantly, and, you know, it's already started its retracement, and, you know, you'll have to ask yourself if it's worth waiting because you haven't reached your adjustment point or your maximum loss, or if you take that preemptive strike and you make the adjustment prior to the move. So we'll go for a couple more days here. And you see that you're hanging right on that upper short strike. So again, all kinds of variations. The bigger, the most important thing that I'm trying to articulate is start here, follow these adjustments, follow these guidelines, and begin to build some confidence in this method, so that when you layer that on top of some of the other methods and some of the other guidelines, you will see that the true power comes in diversifying across many different methods. And then you'll find that you may just really resonate and you like this, or it's not so appealing. You prefer to target larger trades that have much greater potential. Either way, finding what works best for you is the big secret and the really important avenue, I guess, to walk on. So we'll probably have some edits on this later. I was having a little bit of technical issues a little bit ago, so thanks much, and we'll have the next video lesson is absolutely going to be every bit of an hour long, because the T3 is one of the most powerful trades in combination with the T2 and the T1 and the T4, all of these. But I am absolutely going to be taking plenty of time with the T3, so get ready for that one. All right, thanks guys.